Hello and welcome. I'm Hannah Jacobson and I'm here to introduce you to a webinar recorded here at the Kiah head offices in Canberra. The presenter of this session is Kiah MD John Glenn. John spent 23 years in the military where he had both the Special Forces and Communications and IT speciality. By his own admission, he was better at delivering the tough, urgent and complicated rather than the other army stuff. He has turned his hand to industry for the past 20 plus years as a consultant, as a GM at a startup, all the way through to looking after businesses across Asia and Japan for HP. John holds tertiary qualifications in history, mathematics, engineering, computer science and management, and he has studied at Harvard and Oxford, which he often refers to as ego-tourism. As the founder and MD of Kiah, a successful national business, John delivers on his passion for better delivery of public services by dealing with the difficult. Now, over to you, John.
Hello and welcome. Clearly I'm John Glenn, and thank you, Hannah, for your kind words. For those who have been partway through this journey before, this was being recorded or delivered as a live webinar, but our internet dropped out, as only technology can do in the middle of something that's live. So now we're recording it and making it available to you as a recording. So if you've heard part of it, you might want to skip it, or there might be new jokes partway through. Who knows? But as I said before, our business is about challenging the status quo, because the status quo isn't good enough if you want the extraordinary, if you need to break through to new problems of today. If you don't have any challenges, then the status quo is fine, but the status quo won't take you to anywhere new. I do hope you'll find some of what I say to be confronting, because unless we're challenged in our thinking and our current approaches, we won't consider a better future or better outcomes. We'll be destined to simply repeat the past. I do know it takes courage to face new challenges, to go somewhere new. But that doesn't mean being foolhardy, it means being considered. It means accepting some risk, but that shouldn't be a gamble. Everything I talk about this morning has been done by us in one or more projects. We needed to be different in order to break through and deliver the outcomes our clients wanted. I did think I would talk about deal making today as a topic, because it's been said to me that that's not a comfortable term within the public sector. It's a bit too commercial, a bit crass, a bit cringy, unrefined, smacks of being underhanded and sneaky and very discomforting. And I do understand the view, but it doesn't alter the fact that not only do you need to do deals, you do them every day. To do a deal is to come to an accommodation, an agreement for each party's benefit. It is in fact the definition of enlightened self-interest. When I do something for you in order to get what I want, that's the deal. We see deal making in the political context between parties and political stakeholders every day. Multi-issue, multi-dimensional trading to get the things that one party wants by giving things more important to the other stakeholders. We see it in intergovernmental and interdepartmental agreements and between organisations. I'm truly not a fan of consensus or of avoiding disagreement for the sake of avoidance. I am a fan of finding pathways to agreements so that I get the maximum value for the issues that are important to me. Few agreements are successful without some accommodation, unless one side holds overwhelming power. Generating negotiating power is a valid tactic, but agreements based on a large power imbalance do tend to unravel. No one likes to be controlled or forced. So deal making it is. And if you have a better term for it, I'm happy to hear it. But in the meantime, let's talk about doing a deal. I am going to talk about this in the context of procurement, but the principles are applicable everywhere. I use procurement because we do it a lot. All of us do it at some stage, and the examples are easy to understand. They're measurable. And after all, procurement is just a process, isn't it? I see departments everywhere detailing their procurement processes. Volumes of process and procedure well written in the back room, telling you how to do your job, despite not knowing the circumstances that confront you. I'm okay with guidance, I think it's fine, but dictates are more worrying. We know that competition, for example, is the key to unlocking value. Adherence to a process is safe, defensible, no arguments about cosy agreements with perhaps a whiff of impropriety, others saying you've gone outside the process, never laced with a pinch of bias or influence. And traditional processes are fine for simple procurements. The pens, the paper clips, the commodity items, the transactional. But following dogma without thought is not really a good approach, and certainly not a good approach for complex problems. Let me give you some examples. A common call I receive is, "Hi John, we've been through tender evaluation and we've got 300 issues to negotiate. Can you come and help us work out our position?" One day we'll talk about the underlying problem with that particular statement. But recently I received just such a call from an old client. And as I love my clients unreservedly, off I went to see them. Building in rapport with the tender team, I started the meeting with, "You must be excited. You've been through writing the requirement, the tender in the market, evaluation, and now you're at the culminating point. So congratulations." There was a bit of a shuffling of the feet, fiddling of the pens, and avoidance of eye contact until somebody eventually said, "Thanks, John, but we are a bit disappointed. We don't think the selected tenderer can actually do the job." You sort of sit back on your chair and go, how can this be, having followed the proven processes? Well, here's the problem. This was a large government department, wasn't Defence, it was someone else, but who had gone to the market for a prime solutions integrator to deliver a large IT systems implementation. They had narrowed down to two major contenders. One they particularly liked because they had strong project management, integration capability, and would implement well. But their technology stack didn't align with the departmental architecture or score high in the evaluation. They would almost certainly deliver a substandard solution extremely well. The other main contender was the reverse. They had a most favoured technology solution, but the client was not at all confident that they could deliver. The traditional processes delivered a Hobson's choice. Whatever choice the department made, the department would lose. In this instance, if you approach the market the wrong way, you may find it inflexible and delivering an answer that you don't like. And if you haven't built the flexibility in your tendering or acquisition process, you might struggle to find a remedy under traditional procurement rules. In this instance, the interest of the vendors was winning the work with the partners of their choice. And the choice of partner might be driven by strategic or personal relationships, best margin, experience through previous engagements, the known ability to work together, a trade-off for some other deal between them. There are many more factors at play in choosing a partner here than the best possible solution for the buyer. The buyer's interests are only part of the equation. And none of those interests I talked about are actually related to the buyer's outcome. Let me give you an example. When I was at Hewlett-Packard, they had a suite of high-quality, well-priced, very competitive networking products. They were only sold through third parties. We could not offer them in a HP-led solution because of a strategic relationship with Cisco. Hewlett-Packard had a strategic position with another vendor that it thought so valuable that it chose to compete against itself. So the client couldn't get the best deal that it wanted. Just as an aside, that agreement fell apart pretty quickly when Cisco brought a series of servers to the market and started to compete with HP on their turf. But the point of this story is that the buyer wants partners of the buyer's choice. The vendor chooses partners to address the vendor's interests. In the department's example above, that we just discussed, the vendor's interest dominated the deal, not the buyer's interests. An incorrect or incomplete strategy in approaching the market may well end in a suboptimal solution. Let me give you a second example to test your thinking about tendering and process. It is dogma that competition is the key to a best deal. And competition is achieved through an approach to the open market or at least a limited competitive tender. No doubt competition is key. But is it always true that you have to do it through an open tender? Was the threat of competition enough? Let's consider another approach we took with a government client of ours who was so frustrated with the incumbent service provider. The service provider had won the original contract through competitive tender, open market. Several years later, though, still operating under the same contract, the buyer now considered the cost of services to be too high and was disenchanted with the contract and the agreement. Not with the services, just the price. And the department's view was actually quite reasonable. The price was too high. The buyer originally approached the market with a short-term contract because they were unsure how long the services would be required. They reasonably protected themselves by including options for multiple extensions. The program now was in a different state. It was steady and looked like it was going to continue for several more years, so a long-term contract could be offered. The traditionalists in the department demanded a new competition, open to all, be undertaken. How else, they argued, could you generate competitive pressure? How could the department, without competition, open competition, be confident that the price was the best price possible? But if you look deeper and understood the business of the service provider, it would become clear that the impediment to entering the contract for a new competitor was the startup costs. There was significant infrastructure investment required to support the services, and these were owned by the vendor, the incumbent. This was a major hurdle to valuable competition to everybody but the incumbent. The initial short-term contract price included the recovery of the startup investment costs. But the recovery of non-recurring expenditure was repeated on every extension. This was a very profitable business to the company after the first term. To be honest, this was an own goal for the department. A better deal design would have seen a price break for any extension or a separation of the non-recurring costs into a different price model. Even an alternative would have been better, which could have included the right to buy out the infrastructure investment for a token, given the department had already paid for it. The circumstances in which the department found itself was a direct consequence of poor deal design. The buyer should have thought about the deal more strategically and long-term, but rather than just follow a traditional traditional tactical process. Addressing the problem by returning to the market through traditional open tendering would have simply resulted in one of two options. The incumbent could have offered a price that would have been marginally better than a competitor and win the deal, continuing to make significant profit at the department's cost, albeit a little better than what they were paying now. Alternatively, a new supplier might have won the deal with a marginally better price than the incumbent, and that would have brought the attendant costs and risks of transition to a new supplier for minimal gain. Whichever way you went, the department would have still been paying too high a price for the services. After conversation with our client chose to hedge his bets. He said if we could negotiate a deal of value, 10% reduction was his target, then we could argue that the negotiated deal avoided the risks of transition, was of value to the department and obviated the need to go to tender. But he also said we had to do it before the tender was released, so we were in a race with the tender team. Well, I wouldn't be telling you this story if it didn't work out. We went to the incumbent and offered a deal. If they could reduce the price significantly, we could offer them a long-term contract without competition. Here's a trade of value. To protect ourselves, so we knew what we were talking about, we actually built the business model of the incumbent so we knew what the price should be or could be. Filling in spreadsheets like this was the dream of every MBA student. The vendor grasped at the chance, sat at the table with me and said, we can offer you 5 or 6%, and then said, John, we're friends, we've known each other a long time, maybe 10 or 12%, or maybe I can get that over the line. And I leaned across and said, our numbers show that it should be 32%. By the time negotiations had settled, based on the facts that we put on the table, we settled on a 30% reduction. Let me put this in dollar figure perspectives. This was a $30 million a year reduction on a $100 million a year contract that had another 5 years or longer to run. By our estimates, this was between $20 and $25 million better saving than could have been achieved through open competition, without any of the risks or the costs of transition and tendering. In our view, we were aiming for best possible price, not best competitive price. They are a different number. You can have competition without tendering. You can sometimes get better value with better deal design. Whatever you do, though, you need to do the deal design and understand the market in order to get the best value. In this case, we were after low risk and continuity with a price reduction. The incumbent was after continuity at low risk with continued profitability. We both got much of what we wanted. The advice here is to design the deal to bring the parties to the table in the right frame to address both yours and their interests. You need to understand their interests as well as yours. You need to do it in a frame ready to negotiate well. And this is the job of the buyer. It's more than follow the bouncing ball and hope the process brings you an end. And it's much more stringent than those who get comfort from process would lead us to believe. Do the numbers, know the business, don't take the market's word for it or the process at value, even in competition. Knowledge is power. So we know that competition is value, but if competition is key to getting value, why do we stop so early? Let me talk you through this journey. A few years ago again, I walked into a client team with my icebreaker, how excited you must be to be at the end of your journey, to receive a response that said, we actually prefer the other company, but they were $15 million too expensive. I asked if they confirmed the price. They said, yes. We asked a clarification question. We asked if their price was correct, and they said it was. What else do you think they could actually say if nothing changed? Thus, said my client, the selected offer is the best value for money. We just aren't confident of their solution as we are with the other vendor. The selected tenderer was considered to have some weaknesses in their delivery. The preferred tenderer, the number 2, was too expensive. The problem was no one knew why the preferred tenderer's price was higher. This client had the courage to enter a parallel negotiation to see if the weaknesses of either tenderer could be remedied. That meant building a model for negotiation that allowed the evaluation of value for money during negotiation, not before it. To be fair, it was a bit hair-raising and a bit courageous by the client, as this approach was entered into by agreement with the parties as it had not been designed into the procurement process. That's a bit of danger ground. In negotiation, though, let me say, you can ask questions and change both the question and the answer to derive best value. You can't do that when you just ask clarification questions. You can only ask about the answer. It's like being at the high jump. If you only change one side of the high jump, you limit how high you can jump. If you can change both sides, you can go as high as you like. With the preferred tenderer, we explored why the price was high, and we came to understand that they had formed an assumption based on their international lawyers viewing the wording of the RFT in the draft contract. A slight change to the wording without any effect on what it was we were delivering from or asking for on our side, and it was only an approach that's possible in negotiation, resulted in a marked change in price. And you can guess it took $15 million worth of risk and obligation out of the tenderer's eyes, making the preferred tenderer now both the preferred and selected tenderer. The offer definition phase, now so prevalent in defence and contracting that follows defence-style tendering, isn't actually the answer. It's interesting, but it doesn't give you this answer. But that's for a different storyline one day too. We often get pushback on this about probity pundits who say everybody must have the same opportunity, and they are right. It's inviolable. Particularly in public sector competition, you must give everybody equal opportunity. But that doesn't mean they have to have the same journey. They have to be allowed the opportunity to take the same journey. Where they go is their choice. Evaluation of the offers ought to identify the companies where the best value for money can be negotiated. Competition ought to be in play until the very last minute. Negotiation, not evaluation, is where you generate value for money. So there's a few things to think about. So let's move beyond the process trap and consider strategic negotiations from first principles. Strategic negotiations beyond process is worth it for the big, the complex, and the multi-party. The outcome you are seeking is not a transactional contract, but an agreement that creates claims and keeps value. In creating the value, by structuring the deal so that it delivers the value by addressing your interests and those of the other participants. By claiming the value, it's not win-win and equal opportunity, but it's important to claim the value through your approach to the market and the negotiation that's of value to you, so you maximise your outcomes. And by keeping the value, by structuring a deal that keeps on working after contract signature. It's the keeping on, keeping on. The first challenge, of course, is to identify your value. In the private sector, this is relatively easy because it is about money and the bottom line. You might structure it in different ways, and different things generate more value, but it's a simple equation and easy to talk about. It is far more challenging in the public sector. How do you measure the value of social good? And what are the elements of the deal that are more important than others in the public sector environment? And it's not money. You must identify these values and interests because you can't negotiate a deal that meets your needs if you can't articulate what your needs are. This is a big hurdle. The values guide your objectives, where you want to go, and they help you identify the boundaries so you don't cross into areas you don't want to go. It's this objective and boundaries that limits your strategy and sets your goal. Set your boundaries and limitations and outline a path to get there. I personally like to draw it with fat lines and shades of grey so that you've got room to manoeuvre. Project managers' nightmares, because there's no easy pathway to see from beginning to end. But you need a general direction and a path to get there, and it ought to be fairly clear because that is strategy. Secondly, understand and align the issues and interests of all of the parties. Make sure you capture what you already know and use the engagement with them to discover more. Use your tender to understand their interests. Look for people and organisations with influence who are not directly at the negotiating table or in the line of the deal, but they might be sitting behind or off to one side. They may have the influence to derail the deal, or they may offer you great value and influence over how the deal can be structured. Then engage with those parties who have influence. And rarely is it simply two parties. This is the negotiation phase that we are so commonly understand. It's the tactics at the table. But also it's more than the tactics because it should cause a constant realignment of your goal, your pathways, and the understanding of interests. You need to learn and adapt as a consequence. It's not an argument. It's a pathway to get to your objective. You need a plan, but flexibility is in adjusting your plan. The engagement, negotiation, and tactics at the table generate the most excitement and adrenaline. It gets the most interest of people wanting to come and join your team and be part of it because it is the exciting stuff. It's also where most training is focused. Don't get me wrong, it's essential to be good at this, but it is the tactical end of the deal making, not the strategic, so do keep it in context. Use this tactical engagement and tactics to discover and propose and adjust, but see it as an activity as the holistic strategic deal-making activity, not the process of getting to the deal. Just focusing on the process and tactics of negotiation will give you a deal, but without the foresight and planning, without the insight and preparation, or the flexibility to manoeuvre, it's a rush to a poor deal. So I encourage you to think about deal making, not procurement. Think about creating, claiming, and keeping value for the long term. Think strategically, not tactically. Now, if you have any questions over the next month, feel free to ask them. There is an email address on the slide, and that will come to me, and talk to me about any issues that you might have with your department, on your table, at work. Other than that, I might encourage you also to have a look at kiah.com/capstone, because I've written a few things there that are a bit pokey because they're intended to get you to think about things differently. Thank you very much for the journey and your time with me today.